Right now, there's a number quietly haunting global finance, and that number is $3.2 trillion. It represents the total exposure China has to assets denominated in US dollars, and for years, it has been framed as a doomsday weapon. Commentators love to ask the same dramatic question. What if Beijing suddenly pulls the trigger and dumps all of it? What if China sells everything and crashes the dollar overnight? On paper, it sounds terrifying. Trillions in US treasuries, corporate bonds, equities, and dollar reserves flooding the market at once. Interest rates spike. The dollar collapses. Washington spirals into crisis. But here is the uncomfortable truth that rarely makes headlines. China cannot do it. Not because it lacks leverage, but because the moment it tries, it would inflict catastrophic damage on itself faster than on the United States. The so-called financial nuclear option is not a weapon at all. It is a trap, and both sides are standing inside it. To understand why this matters, you need to stop thinking of the $3.2 trillion as a pile of cash sitting in a vault. It is not. It is the accumulated byproduct of 40 years of export-driven growth. Every smartphone, appliance, and machine tool shipped overseas generated dollars. Those dollars flowed into Chinese banks, then into the central bank, and from there into global markets. Over time, the safest and most liquid destination was the U.S. financial system: Treasury bonds, agency debt, dollar cash reserves, equity stakes. This exposure is not optional. It is structurally embedded into how China grew rich in the first place. That is why the idea of a sudden sell-off is misleading. Selling is not a clean exit. It is an implosion. The moment China dumps U.S. assets, prices collapse. But those same collapsing prices immediately slash the value of the assets China still holds. You cannot sell trillions without destroying the market you depend on. That is the paradox at the heart of this standoff. China looks powerful because the number is large, but the size of the number is exactly what makes it unusable. This is not a standoff built on threats. It is built on mutual constraint. And that is why the real story is not about an attack that might happen. It is about a slow-motion struggle to escape a trap without detonating it. To see why China cannot simply walk away, we have to break down what that $3.2 trillion actually consists of. A large invisible portion is U.S. Treasury bonds. As of the mid-2020s, China holds a little over $700 billion in treasuries. Far less than a decade ago, but still enormous by any standard. That alone makes China one of the largest foreign creditors of the U.S. government. But treasuries are only the surface layer. Beneath that sits a massive web of corporate bonds issued by American technology firms, financial institutions, and industrial giants. Add hundreds of billions more in dollar cash reserves held for currency management. Then layer in mortgage-backed securities tied to U.S. housing markets, assets that China bought aggressively after the 2008 crash when prices were depressed. On top of all of that, state-linked funds and Chinese institutions hold well over $1 trillion in U.S. equities. When you aggregate these exposures, you are not looking at a speculative bet. You are looking at the savings of a nation recycled through the dollar system. This portfolio exists because China ran persistent trade surpluses for decades. Export earnings had to go somewhere. Holding cash made no sense due to inflation. Investing domestically would have driven up the currency and killed export competitiveness. So the dollars flowed outward and parked in U.S. markets. Each purchase of a U.S. asset reinforced a weaker renminbi, cheaper exports, and more trade surplus. It was a self-reinforcing loop that powered growth. This is the first layer of the trap. The assets are not independent of the Chinese economy. They are its mirror image. If China tries to liquidate them rapidly, the consequences boomerang instantly. Bond prices fall, yields surge, and the dollar weakens. But that weaker dollar means every remaining dollar asset China holds is suddenly worth less in real terms. A 20 or 30% dollar drop does not just hurt the U.S. It vaporizes hundreds of billions from China's balance sheet in weeks. That loss does not stay abstract. It hits reserves, banks, and confidence at home. The trap is structural because the exit destroys the exit value itself. Now let's stress test the nightmare scenario everyone talks about. Imagine Beijing orders an aggressive sell-off. Hundreds of billions in treasuries hit the market in a short window. Even the deepest bond market on earth cannot absorb that without chaos. Prices plunge, yields spike. 10-year treasury rates jump from mid-single digits toward levels not seen in modern history. That alone sends shockwaves through mortgages, corporate borrowing, and government finance in the United States. Housing freezes, credit tightens, risk assets wobble, panic headlines follow. But here's where the narrative usually stops, and where reality becomes far more dangerous for China than for Washington. As yields surge, the Federal Reserve has tools. It can step in as buyer of last resort. It can expand its balance sheet. It can stabilize the Treasury market, even at the cost of inflation. The United States controls the currency in which the crisis is denominated. China does not. As the dollar weakens under selling pressure, China's remaining dollar assets lose value immediately. At the same time, the renminbi strengthens sharply by comparison. That sounds positive until you follow the chain reaction. A stronger currency crushes export competitiveness overnight. Factories face shrinking margins. Orders slow, employment pressure builds. Meanwhile, Chinese companies that borrowed in dollars now face a double hit. Their revenues are mostly in renminbi, but their debts are in dollars. A sudden currency shift and higher global rates make refinancing brutally expensive. Defaults rise. Banks absorb losses. Liquidity tightens at home. Then comes energy. China imports the vast majority of its oil and gas, priced globally in dollars. A collapsing dollar market and volatile exchange rates mean higher effective costs in local terms. Energy inflation feeds directly into manufacturing and consumer prices. The state is forced to intervene, burn reserves, or print money. None of these are painless options. What began as a theoretical attack on the U.S. financial system quickly becomes a domestic crisis inside China. This is why the sell-off scenario remains hypothetical. The damage curve bends inward faster than outward. Because a sudden exit is impossible, China has been forced into a very different strategy. Instead of detonating the trap, it has been trying to dismantle it piece by piece over decades. This is the part most people miss. China is not frozen in place. It is moving, but slowly, deliberately, and quietly. Every reduction in dollar exposure must be small enough not to spook markets, yet consistent enough to matter over time. This is why headlines about China selling a few dozen $billion in treasuries matter far more than they appear. They are signals, not attacks. The first pillar of this slow escape is diversification away from paper assets that sit fully inside the dollar system. Gold plays a central role here. Over the past decade, China has steadily increased its official gold reserves, and many analysts believe the true figure is far higher than what is publicly reported. Gold serves two purposes. It reduces reliance on dollar-denominated reserves, and it provides a politically neutral store of value that cannot be frozen or devalued by another country's monetary policy. This is not about returning to a gold standard, it is about insurance. The second pillar is infrastructure rather than assets. China has invested heavily in building payment and settlement systems that allow international trade to occur without touching the dollar at every step. Bilateral currency swap agreements, cross-border settlement platforms, and direct clearing mechanisms allow Chinese firms to transact in local currencies or renminbi instead of routing everything through New York. Each transaction that avoids the dollar reduces the need to hold dollar reserves in the first place. This is not dramatic, it does not crash markets, but over time it chips away at the structure of dependence. None of this produces headlines because it is not meant to. A fast exit would collapse the system. A slow exit stretches it. That is the tightrope Beijing is walking, knowing that every step forward still leaves it exposed to shocks it does not control. Here is the deeper problem. Time is not moving at the same speed for both sides of this trap. China needs decades to reduce its dollar exposure safely, but the pressures inside the dollar system itself are building much faster. This mismatch is what turns a controlled exit into a race. On one side, China is trimming holdings, shifting trade settlement, and rebalancing its economy toward domestic consumption. On the other side, the United States is adding debt at a pace never seen outside wartime. Trillions in new borrowing every year, rising interest costs, and political gridlock around fiscal discipline are steadily eroding confidence in the long-term stability of the dollar. As global investors watch this unfold, behavior changes. Central banks diversify reserves. Trade contracts experiment with alternative currencies. Financial institutions hedge against dollar volatility. None of these actions collapse the system overnight, but together they accelerate the decline in the dollar's share of global reserves. That decline matters because reserve currency status is not permanent. It is sustained by trust, liquidity, and scale. When confidence slips, even slowly, the adjustment process can suddenly speed up. For China, this creates a nightmare scenario. If the dollar weakens gradually over 30 years, Beijing can manage the losses. But if confidence cracks within a single decade, the value of remaining reserves collapses before diversification is complete. That is why China cannot simply wait and hope. Yet it also cannot move faster without triggering the very instability it fears. This is the essence of the trap. The safest path is too slow. The fastest path is self-destructive. This tension explains why Chinese policy often appears contradictory. One moment promoting renminbi internationalization, the next tightening capital controls. One moment encouraging outbound investment, the next pulling it back. These are not random moves. They are attempts to balance momentum against stability in an environment where every lever pulled affects global markets. The trap is not static. It tightens as external conditions shift. What makes this standoff truly dangerous is that it is mutual. The United States is not an observer, it is a participant. Washington understands perfectly well that China holds trillions in dollar assets. Even if those assets cannot be used aggressively without self-harm, their existence limits policy options. This is why financial pressure applied to China looks very different from pressure applied elsewhere. Freezing reserves on a massive scale would be a declaration of financial war. It would push China toward the only remaining option, liquidation, regardless of the cost. That is a line the United States has been careful not to cross. Instead, both sides operate in a gray zone. Tariffs, export controls, investment restrictions, and technology bans all apply pressure without directly touching the core financial linkage. This preserves the fragile equilibrium. The dollar system remains intact. China continues its slow adjustment. Neither side escalates to the point of rupture. From the outside, this can look like indecision or weakness. In reality, it is risk management under extreme constraints. The result is a form of financial deterrence. Not the threat of action, but the threat of mutual damage. Each side knows that pushing too far collapses value on both balance sheets. This creates restraint, but also fragility. Deterrence works until it doesn't. A political shock, a banking crisis, or a loss of confidence could force actions neither side wants to take. That is why the most dangerous outcome is not a deliberate attack, but an accidental one. A crisis triggered by debt, inflation, or market panic could force rapid decisions under pressure. In that environment, the slow exit strategy breaks down, and when it does, the trap snaps shut. Looking ahead, the next decade does not revolve around a single dramatic event, but around which stress breaks first. There are three broad paths this system can take, and none of them are clean. The first is a managed transition. In this scenario, the dollar slowly loses dominance without collapsing. Its share of global reserves continues to decline, but it remains the anchor for global finance. China keeps reducing exposure gradually while expanding non-dollar trade and domestic demand. The cost is persistent volatility, slower growth, and repeated financial scares, but no sudden rupture. This is the least destructive outcome. Yet it requires extraordinary discipline from both sides at a time when political incentives favor short-term gains. The second path is a disorderly shift triggered by shock. A debt crisis, a banking failure, or a sudden loss of confidence could force investors to reassess risk all at once. Capital moves quickly. Liquidity dries up. China faces a choice between absorbing massive reserve losses or accelerating diversification under pressure. The United States responds with aggressive monetary intervention. The result is not collapse in a single night, but a violent repricing of assets across currencies, bonds, and commodities. This scenario is dangerous because it feeds on itself. Once trust breaks, it is hard to restore. The third path is the most counterintuitive. Nothing dramatic happens at all. Instead, the system decays. Inflation quietly erodes purchasing power. Debt grows. Growth slows. The dollar remains central but weaker each year. China remains exposed, but gradually poorer in real terms. This slow bleed avoids headlines, but destroys wealth over time. It is politically easier to tolerate, which makes it deceptively likely. In all three cases, the key insight remains the same. There is no clean escape. The trap does not spring because someone chooses to pull a lever. It tightens because the system itself no longer supports the weight placed on it. The final lesson of this entire confrontation is not about who wins. It is about structure. For 40 years, the global economy was built on a simple exchange. China produced, the world consumed, and the dollar recycled the surplus. That structure generated unprecedented growth, but it also locked both sides into dependencies they can no longer escape cleanly. The $3.2 trillion is not a bargaining chip. It is the physical evidence of that lock-in. China cannot sell without destroying value. The United States cannot ignore the implications of that exposure without risking instability. Both are constrained, not by ideology or intention, but by balance sheets and incentives. This is why the most important shifts are happening quietly. Reserve diversification, trade settlement changes, energy contracts, financial plumbing. These are not revolutionary acts. They are adaptive responses to a system under strain. For individuals watching this unfold, the mistake is to frame it as a binary conflict. This is not about choosing sides. It is about recognizing that the architecture holding global savings, wages, and purchasing power is changing. Slowly at first, then unevenly, and possibly all at once. When currencies are trapped in mutual dependence, volatility becomes the norm rather than the exception. The dollar will not disappear overnight. The renminbi will not replace it tomorrow. What will happen is erosion. And erosion reshapes outcomes without asking permission. Understanding that process is the difference between reacting in panic and positioning with clarity. This is not a prediction of collapse. It is a warning about fragility.